Welcome to Season 3 of the Knack for Business podcast, over 250 episodes strong. We're here to ignite your entrepreneurial spirit with fresh insights, networking gems, and creative strategies that elevate your game. Are you ready to discover what your Knack for Business truly is?
Today's topic is time value of money. Your hosts are Bernie Franz from Creative Insight and Wayne Pratt from Motivate You Inc. So what can you expect from the Knack for Business podcast? It aims to help you find your feet in the business world. Whether you're just starting out or you've been at it for a while, we have something for everyone. In each episode, they dive deep into the particular area of business and explore the ins and outs of that subject. They interview guests that are experts in their field who share their success stories and experiences. They offer practical tips and advice. Our guest today is Caroline Troy from Troy Valuations. Caroline is the founder of Troy Valuations and has been at the helm since its inception in January 2012, steering the firm to a leading position in business valuation and advisory. With over 2 decades of experience in Canadian capital markets, her expertise encompasses guiding entities through expansion, financing, and restructuring strategies. Caroline, who holds a bachelor's degree in economics from the University of Calgary and an MBA from Wilfrid Laurier University, also earned the Chartered Business Valuator designation from the CBV Institute. She serves on the board of directors for Systemic Trust Company, a subsidiary of DMG Blockchain Solutions, Inc. Recognized as an expert witness in Alberta's Court of King's Bench, Caroline's insights effectively bridge traditional finance with emerging technological and sustainability training, marking her as a pivotal figure in devising transformative strategies for an evolving global market. Caroline, welcome back. This is our second podcast with you. Glad to have you back. What is your favorite quote or saying?
Oh, that would be a quote from many years ago by Margaret Thatcher. She says, "The problem with socialism is that eventually you run out of other people's money."
So what's your business tagline for Troy Valuations?
My business tagline at Troy Value is clear, fair, value. It's a play on words. Fair value is a defined valuations term, but the clear part and the fair part come from the idea that, first of all, you have to understand what I'm talking about. And then secondly, that any transaction you do or negotiation you enable, you walk away both sides winning. I think a winning transaction is when both sides win. There's often where both sides lose, but if you can walk away with a win, it's better than a lose. So that's my play on words for clear, fair.
Why is the value of time critical for business owners to understand? What does that all mean?
Both. Okay. Can we play a game?
Sure.
Okay. Because it's more fun if we play the game. Let's say, for example, Wayne, we'll pick on you, Wayne, because it's fun. I owe you $100. Can I pay you in a year from now, or do you want the money today?
Today,
Okay.
because I've all kinds of places I can put the $100 now, and people will charge me interest if I wait a year to pay them.
Fantastic. So you've got the time value of money. You figured out that money today is worth more than money in the future. The money in the future has a different value than it does today. And that value is dependent upon a bunch of things. One of them for sure is the one that Wayne brought up, which is that he can invest it and earn a rate of return that, had I kept his money, he would have forgone. So there's the interest rates today. The second one that I can think of is inflation. I think that inflation is running about 5%. If you look at Stats Canada's and the Bank of Canada's inflation measures, they are using what they call core inflation, which is statistically valid because it gets rid of the highly volatile prices of food and fuel. If you include things like food and fuel, then the price of inflation is currently around 5%. For example, on that $100 that I owe Wayne, if I give it to him today, he can buy $100 worth of stuff. But in a year from now, that $100 is only worth $95 worth of stuff. So there's the inflation rate. Then there's a third concept. It's more like an economic concept about utility. If I've got Wayne's $100, I can buy a good looking boat and sail past Wayne. It's a small boat for $100, but I can look at Wayne sits on the side on the beach on the dock and watches me as I go by in his sailboat and I wave at him. And he gets his nose out of joint because he can't then buy the boat. So he can't enjoy the money that I have. And so he needs to be compensated for that value. Those are at least 3 ways that you need to be compensated. And so that really comes down to the heart of the time value of money. So I'm asking you again, Wayne, can I pay you in a year from now that $100?
I want 120 in the year.
There you go. Now you figured out what the, I don't know, cost of equity, weighted average cost of capital is, because you just told me it's 20%, and that's how you calculate it.
Do I win a prize?
A small
What
boat.
bonds?
A small boat.
A small boat.
Now, using that construct, is there ever a time where if you drop $100 into someone's lap, because your depreciation, right, or the influence of economics, is there ever a time where that money being dropped in increases in value? Almost like you put a seed in the ground, right? The seed itself is worth so much, but if you water, grow it, etc., it becomes something else. In which case it's transmuting itself in some way, shape, or form. Is there a financial construct where that condition can happen?
Absolutely. Absolutely. So what you're talking about is the future cash flow from an investment. Let me talk about a winning lottery ticket, because this is a good way for people to understand. Several years ago, there was a lottery, and it was called Millionaire for Life. And if you're long in the diagram, you'll remember that they had these commercials where there was a person and a couple, and they had a bike and another bike and a car, and these assets started popping up behind them as they were standing in front of the camera. It was a cute commercial, but if you held the winning lottery ticket and scratched and won, the lottery corporation would pay you $1,000 a week, $4,000 a month, $52,000 per year for 20 years. They called it Millionaire for Life because if you added up all of those $1,000 payments, it worked out to be $1 million. So you put $2 down on Lotto 649 and you get $1 billion back. That's the investment. That's also true if you buy a rental property. You put down $1 million on your property and rent it out. Presumably, you will repay your investment and hopefully recoup the cost. So this is where the time value of money comes into it. Going back to that lottery payment from the winning lottery ticket, I would argue that the last $1,000 doesn't have as much value as the first $1,000. You need to calculate not only the present value of future cash flow, which is the $1,000 over 20 years, but you also have to take it to today to figure out what the present value of that future cash flow is. I'll give you another example. Let's say there's an annuity. So you bought a condo for $10,000 and you're going to get rent on that condo over the next 10 years of $1,000 per year. Okay. So there's your stream of cash flow, $1,000, 10 years, you should be equal to $10,000. Easy enough. Except when you take the present value of that calculation, it's something less. That last $1,000 is not going to buy as much as the first $1,000. So using that present value calculation formula, you need a discount rate. And that's what Wayne just talked about with the 20%. That's his discount rate. He says he's going to discount it at 20%. So I've done the math because I do. And at 10%, that $10,000 income stream, $1,000 for 10 years at 10% returns a present value of $614. If you use a slightly higher rate, say 25%, close to Wayne's idea of $20, then that returns a present value of $357. And if you use an even higher rate at 33%, it returns $286. So why do we care? First, we need to know whether we're going to take that annuity, that stream of cash flows. And secondly, we want to figure out what the cost of that annuity is. I would argue that you take the present value and do that discount. This is also true when you get into a situation where you are buying a business, like condominium, a rental unit. You want to take that discount rate and present value those cash flows. But it's complicated, right? There's exponents and divisions, and there's having to calculate out the future cash flow and forecast. People don't like to do it. So what they like to do is go, what's 3 times cash flow? Or what's 4 times cash flow? Or what's 5 times cash flow? Because they know those numbers. It's easy to multiply the historical cash flow by a number, 2, 3, 4, and get close to the present value of future cash flow. So in that example where I said at a 25% rate, the present value of that future cash flow is $357. That's close to 4 times 25%. The invert of 25% is 4 times. 4 times cash flow is $357, which is close to $400, which is close to a 25% return. So that's one of the ways you want to look at it. And that's why you want to think about the return on your investment using the time value of money as well as the absolute value. Does that make any sense?
It does, but one thought that pops into my head. First off, you explaining to me when I looked at some Excel spreadsheet, the formulas, and I'm going, what the heck's present time value all about? Yeah, not for me, because I wouldn't know what the right answer would look like. You'd have to understand the concept before you actually stuck your finger in the mousetrap. But what I did understand from what you just explained, that you're having a return. So if the pot of cash is in front of you and it's liquid and for your use now, although you're doing over time, you take the $100 and buy something like a condo, probably a really small condo for $100. Again, with the small stuff is big. The question I would ask then, because the condo itself typically appreciate in value, assuming it's taken care of.
Yeah.
Is there a benefit where the time value ratio, so getting 20, 25 points back? I guess what I'm trying to ask is, does it make sense to drop money in that position? And then are there benefits in the long term, let it grow versus a bank account, which might give you maybe 1, 2 points in a savings account, if that, versus you put it in a stock or you're some sort of investment where the return could be riskier, but more volume. How do you figure that this is the best way to put that money in? So if I had $100 here, $100 here, $100 here, one goes off in this direction to the condo, one goes off towards the boat, one goes off part in a bank account. You're moving, your eggs are all in one basket. How does time then correlate into that structure? What's the smart way of assessing it? Knowing that one will have a yield 10 years from now, one will have a yield maybe tomorrow, and so forth.
So there's a bunch of things that you're talking about there. One is a risk return problem, right? Let me say that that investors generally are risk adverse. Okay. What does that mean? That means that we want to be compensated for the risk we incur for delaying our consumption of the investment. So it's $100. Wayne needs to be compensated for the time at which I own his money. He's going to put off his consumption. He wants to buy a boat, but he's going to have to wait a year to buy his boat because I've got his money. He's made an investment in me, right, on that $100. So if we're risk adverse investors, then we need to be compensated for that. That risk is related to both the investor and the investment. Wayne may not foresee that I'm a big investment risk, that I'm highly likely to pay him back. But Bernie, you might think that I'm a big investment risk. And so I'm going to go to real estate. There are lots of people that flip houses. Right? I don't flip houses. I have had one house for 25 years and now a second house, and I've had it for 5 years. I don't flip houses. The people that are in that market, they go, oh, this is easy, right? We spend an X amount of dollars, change some windows, put a fresh coat of paint on it, and we sell it for a higher amount. And I look at that and I go, no way, I can't do that. Everybody's got a different sense of risk and this different requirement for the reward they demand. There's something else that goes into this, and that is, you mentioned both an investment or spending, right? Inflation is an insidious problem. Inflation penalizes, it punishes savers. So if I take my money and leave it in my bank account, or Wayne takes $100 and doesn't give it to me expecting the $20 return in a year, he just leaves it in his bank account, he's going to automatically lose out on the inflation, right? It's going to erode the value from $100 today to $95 in a year. So that's a real punishment for savers. In our environment, we have relatively high interest rates compared to a few years ago. 4 or 5 years ago, the price of money as measured by interest rate was just about zero, if not negative. And low costs of money, they really reward investors that like to take risks. And so those are real estate investors and equity investors. And we know this is true because you can look at the low cost of interest rates from following the great financial crisis in 2008, beginning 2011 or 12, and you follow that through to about 2019, we had a great bull market in the stock markets, both in the US and Canada. We had low interest rates, we had great bull market, and we had a spectacular gain in real estate because you can buy it cheap, money's cheap, and you can invest it in hard assets. We don't make new real estate, so that's a hard asset. So there's two things that are going on there, Bernie, I think that you're talking about. What's your return and what's your cost? Your cost is inflation. What's your return? It's potentially that future cash flow you'll get from your investment.
I thought of two bad news reasons to call Troy Valuation. One a divorce and one a death. But I'm hoping that there are positive, optimistic reasons to have something valuated. I want to hear your take.
Okay.
Am I right that those are usually the traditional reasons you call an evaluator?
So divorce and debt. Yeah. You want to buy something, you're a business owner and you're doing really well and you want to take out your competitor, or you want to extend your geographic reach. You want to buy a building. You want to spend the high rate of return that you've got. Those are good reasons to call us. You can say something like, I'm considering this expansion and I'm wondering what would be the ROI on that. Is it worth it? Is the cost worth it? This is what I expect, but I don't know if it's going to come through. So those are something you can do. The bad, that's true though, that we often get involved where that you're in trouble. And we're here to resolve those troubles and help you through complex business decisions. If you have your business and it's successful, but you're thinking, it's maybe time for me to retire, I'd like to sell this to my employees, then what should I sell my business for? And that's another really good reason to do it, to give us a call, because you're looking for a transaction that you want to be relatively friendly, but you don't want to give away the farm, right? You want it to be good for you, but also good for your employees. And we can help you structure that transaction so those trusted employees can buy your business. You want to save some tax, you'll create a related party transaction and you want to have us look at that and determine the value before you sign off on it, because CRA doesn't like related party transactions, and they're going to look to see whether or not you did it at fair market value. Those are some of the reasons that are not bad. Not maybe you're not in trouble that you want to call us.
The company is trying to follow the rule of time, value of money based on time, and do it consistently. Like if you're a bank, I think you probably already have this down pat, right? But if you're a manufacturer or a restaurateur or in business, but not in the financial business. So in other words, yeah, it's not my strong suit. How do you make it sustainable? So I'm doing a path and you look over to your accountant going, I want to do this. What do you think? Does this make sense? How do you make sure it stays flowingly? And if you're an upside down situation or sideways situation, well, however you want to define it, and you have to restructure, how do you make it right so that you have good results, what you want in the long term?
So you've asked a really complicated question.
It comes with a small boat though, or a small condo.
Okay. I think that there's a couple of things going on there, right? One is an expansion idea. And then secondly is a restructuring because you're in trouble. In the first case, you are the master of your destiny as a business owner, and you're considering your opportunity set in front of you. If you're a very small business owner, your focus is generally on operations and marketing. You're not considering these long-term goals. If you're a slightly larger business owner, but still small, then you can start to look at buying your competitor or increasing your capacity. You're looking at, you've run into a capacity utilization problem. Your restaurant is full every night, or you're manufacturing and you can't go fast enough. So you've got a capacity problem. And so you want to buy out your competitor, then close their operation. If you have too much capacity, not enough utilization, then you buy out your competitor and shut down their operations, and customers are forced to use your services. That's a different sort of problem, right? As opposed to restructuring. And in those cases, the business owner should really be looking at their operations and looking at their margins and considering the project landscape, right? Who's in your target market? Who's your competitors? What are their operations? And so you need to be able to look at your business and then extend that to your competitor's business. That's a big part of what we do. Restructuring then gives you the ability to forecast how to combine your business with theirs, increase your future cash flow, and figure out the cost of money today. Restructuring is a different problem, right? Your business investment is not performing the way that you would like it to. And so it's again, you need to think about, why is you not doing as well as you could? Are there better opportunities for you to put your money at? And then finally, what is the cost of money? And if you're restructuring, you want to be looking at operational efficiencies and thinking, do I really need 12 people standing around, or can I do this with 5? Or my debt's too high. What assets do I have that I could sell to reduce the debt and therefore reduce my principal payments? What can I do to sell? Is there a better opportunity for me to sell this business and do something else? Right. So I think you're asking a two-piece question, which is refinancing versus expansionary thing. And although the solutions are the same or similar, one is more risk adverse as opposed to risk loving. Hey, this is going great. Let's take on more risk and have some more fun. As opposed to, oh my God, now what am I going to do? I got to fix this problem today.
If you're a banking institution, you tend to be more conservative with moving money around. And if you tend to be another business type, you're less risk adverse, or even there might be high risk. You're going to invest in startups like angel investor, right? so the risk is reduced. Are there particular industries that you find that this is more prevalent in and less prevalent in others? In other words, the risk aversity. That type of approach versus let me ponder this.
I talk to a lot of business owners. I talk to entrepreneurs who are interesting. They have unlocked the secret of how to make money, how to make business operations work. And they are more capable of evaluating risk, both operational as well as financial. But they don't generally be the here, hold my beer kind of guys, right here. They do tend to be less risk adverse, though. There's no doubt about it. They're more prepared to try new ideas, to try different things, and to push on many different opportunities at the same time. For many business people who are considering things, I'd say just do it. Risk aversion is probably the biggest impediment. I'm not sure I can do this. I'm not sure I can pull this off. If you're considering doing it, just do it and put it at risk. Now, if you're 65, well, maybe not. But if you're 25, just do it. You won't look back and you'll learn so much.
Yeah, you learn pretty good at 65, though. You just may not have a long game left in you.
Yeah, but
would-
you're more likely to remember the things that really hurt when you skinned your knees and not do them again.
Very true. Would it be fair to say that if a business had bought a service, say a half-ton truck or a delivery truck, and they're trying something, and they realize, and I've been in a position in the past where I was managing a building, and the utility of the room, the typical client for that room wasn't showing up. The room sat empty, and I have to repurpose the rooms. What is the demand for that type of space, and who would fit the profile for the use of space? So I shifted. It was a 3-bedroom apartment, and the long-term clients weren't showing up for the housing crisis. The short-term clients, where I would have a furnished suite, they were showing up, but didn't want to spend that extra coin, and the utility for them wasn't there. So I took all the walls and turned it into a conference room because where it was attached, there was always a shortage of conference rooms, except those folks who'd usually get that room for free. In this particular case, I had to pay the staff that was not part of that larger operation, and it was not funded by the ministry of anybody. Then I had to return some. There were some benefits, low pricing, etc., because it was attached to the facility. I changed it up. I found another utility for that space. So if you're having a business, is this where you do the time for value analysis? At that point, I'm sitting there going, who do I talk to about this? Is this a good idea? I didn't do a whole bunch of those type of rooms. There was 104 opportunities in that space. In this particular one, I picked the one that was underutilized. Should a business then come to you and say, I've got current activity, almost like a little bit of restructuring. It's low yield. It's not crashing the business, but I'm not maximizing utility of the space. Is that where they come back to you and say, here's a construct? What do you think?
That kind of thing is a little bit outside our scope because I understand money and cash flow and risk, but I don't know every industry. So if you came to me and said you had this problem, I wouldn't know how to solve that. But if you came to me and you said, I have this problem, I think it'll cost me $100 to fix, but I'm only going to get $20 a year more than as opposed to zero today, that's a different kind of solution that you need, right? You're looking for a financial solution. And absolutely, that's something that we do. We do business plans and we do updated business plans. And this is one of those cases where you get a dry cleaner and only have so much space to run your machines, right? I'm actually thinking of the dry cleaner that I go to. There's 2 of them side by side. One of them went up for sale. And I went, you ought to buy that guy. You really ought to buy that guy, right? And he didn't. And I thought, you dummy, right? Just take that little bit extra risk because if 2 dry cleaners are sitting side by side, they're both making money. They might not have captured all of that market, but it's better that you have it than they do. Buy out your competitor if you can. But that's the kind of thing that we can analyze. If you're looking for a solution that you're saying, I got this space, I don't know what to do with it, I got no help.
I knew what to do. And I knew where the problem lies. I knew
Right.
where the internal problem lay. I had three options, right? Actually, two typical options. And then the third one kind of popped in the noodle. I knew another space didn't have the space.
Right.
If I charge at an affordable rate that won't wreck their budget because they are government funded, there we go. Or they could host events there.
Right. Right.
But
So you
no,
knew the solution. What you didn't know was the economic impact.
yeah.
And we can help you with that economic impact for sure. It's an easy thing for us. You'll come to us and say, this is what the problem is. We'll come back with a bunch of questions. And our questions will be focused as to the solution that, right, the three opportunities perhaps that you're evaluating and trying to determine which is the best one. That's how we get to the answer. We'll have the knowledge to ask the questions that you don't have. You've got the operational knowledge that we don't have. And we come back to you with the economic analysis that says you should do this or you shouldn't, or you should take option number 2.
In terms of valuation, if the dream is to go public, you use a combination of a show and hype. And here's how we're going to make this big exit $100 million strategy. If these $100 million buyouts aren't going to happen going public anymore, you have to have private investors who are slower, require less paperwork. I'm guessing it changes how you shape your business rather than doing the paperwork toward an IPO.
That market for going public transactions belongs to investment bankers, big accounting firms, and big legal, right? That's where that goes. And there's a really great community that services that idea, right? We're going to do this big IPO, but that generally it's already got operational success, a great history of operational success. And now they would like to expand or they would like to take some money off the table, right? The investors, the initial investors. That's that market. The private equity market tends to look for, they have a different investment strategy. They're not looking for the liquidity that a public transaction would look for. So when you go public, you hope to get liquidity and your ability to sell your investment is quick, relatively. Private equity, those tend to be smaller companies with great growth potential. Private equity people are looking for that growth potential. Operationally sound, but lacking in financial opportunity. The documentation process and evaluation process is much less strict because and this is a large part because when you are public, you have investors like Wayne and Bernie, right? We don't know nothing. Whereas the institutional investors, the private equity investors, they have a lot of knowledge as to the economic returns that they're seeking. And they have a better sense of risk. And it's not completely true, but that's how the regulators see it.
Does the fact there are fewer IPOs give you a wider playing field at your level of business than you would have had when everyone was chasing that $1 billion buyout?
No, because I'm not in that market. I've done very few go public transactions. I'm more likely to sell my business to my employee than go public.
No, Carolyn, we've spent almost an hour chatting and you've filled us with a lot of knowledge and great advice. What key things, 2 or 3 key things would you want for an entrepreneur to understand about time value of money?
The very first is that there is value to money, that money does have cost and it has a reward and can provide that. That it's not just a thing that's in your wallet, it's what it can do. The second thing is probably that expectations need to be grounded in time. What are you going to do this year, next year, 5 years from now? and to understand where the cash flow is coming from. And then thirdly is how to read a financial statement, right? Really understand how financial statements get built, how they go together, and what each one of the three financial statements can tell you. And what you really want to pay attention to is the one called cash flow, because that's the one that bridges your income during a period and what's on your balance sheet. So my advice to investors and business owners when thinking about the time value of money is understand your financial statements, figure out what cash flow is, and then figure out what the cost of money is.
Carolyn, how can folks reach you?
You can get me at my website, troyvalue.com. That's TROY, V as in Victor, ALUE.com. The value is Troy Valuations, of course, Troy Value. You can get me at ctroy@troyvalue.com, which is my email address. You can find my phone numbers on my website. You can find me on LinkedIn. I have both a personal site and a business site. You can find me on Facebook, again, both with personal and business. I think I'm on X. I think there's a couple of YouTube videos. You might find us on YouTube, Troy Valuations on YouTube, although there's not a lot of traffic there. The best way to find me is either by my email, ctroy@troyvalue.com, or on my website, troyvalue.com, TROYVALUE.com.
I want to say thank you to Carolyn Troy, my co-host Wayne Pratt, and you, the Knack for Business listeners. If you're considering understanding more about the value of your business, want to understand perhaps a project where you're the subject matter expert in that field, finance is not your specialty, Carolyn's the person to help you out. To reach us, it's info@creativeinsight.com. That's info@KREATIVINSIGHT.com, or the website is creativeinsight.com. Wayne, how can folks reach you, sir?
My website, motivateyou.ca, MOTIVE, the numeral 8, the letter U.ca. My email is wayne@motivateyou.ca.
If you would like to be a guest on this podcast and share your knowledge, let us know. We would also appreciate your feedback on the content or format. Check the show notes for more details. For these podcasts, we like to acknowledge the support and thanks to the following people: Carl Richards from Podcast Solutions Made Simple, a renowned podcast expert; Fred Crouch, who is the Property Wizard podcaster, where Bernie is a co-host; Javan Strika from Hiva coworking space that is more than just a space; then Melanie Weber, Bernie's invaluable business partner; and Wayne Pratt from Motivate You Inc., who serves as both a coach and co-host of these podcasts. Disclaimer: please note that the Knack for Business podcast episodes are meant solely for educational and general informational purposes. The information and opinions contained within are not intended to be professional advice on any subject matter. The thoughts, views, and opinions expressed by the participants are their own personal beliefs and do not represent the views of the podcast hosts or any affiliated organizations. It is important to note that this podcast is not a replacement for consulting with certified experts in your area who possess knowledge of your unique situation. The hosts of the podcast, along with any participants or affiliated groups, do not take responsibility for any actions taken or not taken based on the information presented in this episode. It is highly recommended that individuals seek guidance from their own personal advisors in fields such as accounting, law, or other pertinent areas prior to undertaking any actions or making decisions that may impact their financial, legal, or other aspects of life.